Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always out there. Today, I'm going to walk you through the 13F filing of Dr. Michael Burry. All right, very famous guy. You might have heard of him. And we're going to begin today by going over each of his positions, and I'm going to share that with you today. So first, we're going to go over GEO Group. So GEO Group is a private prison stock, along with CoreCivic. We're going to actually combine them and do them together. And I'm going to show you their stock prices here today. So one thing that you want to note, and I've seen this all over YouTube, is that CoreCivic and GEO Group are REITs. No, not anymore. They're no longer REITs, so it's very important that you actually note that or take note of that. They are now C Corps. The reason why they did that is actually because all the major U.S. banks, as you can see from this article, prison companies seek money abroad because they can't seem to get any money here because the banks have refused to lend to them for political reasons, because they are, considered to be very disgusting businesses, very anti-ESG, you could say. And so the companies have, out of necessity, switched over from REITs to C Corp. And let's do a refresher on REITs just in case you're new to the channel. So a REIT is a company or an entity that is a pass-through entity, meaning the money is not taxed at the corporate level, but on the individual level. So in essence, they have to follow a certain criteria, a certain set of rules in order to classify themselves or qualify as a REIT. One of them being they have to pay out 90% of their taxable income to you, the shareholder. That doesn't leave much money laying around for them to invest in the business. Therefore, REITs are very capital acquisitive, let's call it that. And so they have to seek out extra or external sources of capital, such as issuing shares or taking a lot of debt in order to fund growth. Now, when you no longer can take on any debt, well, now you have to maybe use money from the inside. But being a REIT restricts you from doing that because, legally speaking, in order to keep your classification as a REIT, you must pay out a certain amount to your shareholders. So CoreCivic did it first. By the way, keep note of that. CoreCivic did it first. That's important. And then GEO followed. They switched to C Corps. Now they can keep the money inside and they have to pay the corporate tax. So now they do pay corporate taxes at the corporate level, and the shareholder pays a separate other tax that's more favorable if you get a distribution or, dividend, qualified dividend. Okay, enough of that technical jargon. Point being, if you want to know how I felt back in the day, I have this video here for you. It exists 2 months ago, and it is posted August 23rd, 2022. If you're curious on why these stocks are pretty good values, you can go check it out. And since then, the companies have actually performed pretty well. Now, I'll give you the TLDR. Basically, the real estate value underneath it all is actually potentially more valuable than the equity. And so that gives you a decent margin of safety. And when you consider the fact that the operations of the business haven't been really harmed, you're dealing with more of a sentiment issue. And that actually makes it fairly attractive. These companies are actually two companies that I actually wouldn't mind putting it myself in my own speculative side of the portfolio. They're not really businesses that I really like in particular. I think they're very hard businesses, especially with all the political uncertainty. But I can see that operationally speaking, they haven't been really harmed aside from the debt profile. And actually, they've actually come down in debt quite a lot, because I was talking to this morning with a community member who was asking me, hey, Fabio, well, what's going on with the debt? Why is the debt coming down so much? And I explained to them, well, they switched over from REIT to C Corp, and now they're paying down all the debt because now they have to basically rely on keeping their earnings internally and kind of growing that way. So a little bit less, they have to take on less leverage essentially. And that makes sense. And actually, I like that. Over time, I think that's going to provide a good value to shareholders. And if they keep paying down that debt, they're gaining more and more equity in that real estate. Think about that. Pretty interesting stuff there. So I think I understand why Dr. Michael Burry is actually buying these stocks. And actually, in this video, by the way, the reason why it's titled "This One Might Be Better," I was talking about CXW. The reason why I think CXW is a better play is it's a better risk-adjusted play. They have a decent amount less debt, but I think GEO will outperform should the thesis play out. So they're both kind of in line with each other, I guess, here. So if both play out, I think GEO will outperform CXW just because the market is putting a higher discount on GEO Group. Okay, so GEO Group, you can kind of see over this time period, and I'll actually put CXW next to it because I think it's kind of important to illustrate this. So you can see for now, GEO Group, you can see it actually rose up, and now they kind of match each other. I think CXW is actually above it. But again, remember, if more things can go wrong with GEO Group than CXW because the leverage on CXW is better than GEO Group. But if everything goes according to plan, as management wants it to, they should perform better. And this is the one-day chart, by the way. So let me go show you the year-to-date. So the year-to-date, they kind of caught up, like what I was saying. I kind of jumped the gun there. I was showing you the one date because I remember looking at the 1 year. Okay, and then you can see on the 5-year, CXW has outperformed now because right now it's trading at a premium to GEO Group. So just keep that in mind. They actually switched at one point in, I think, it was like 2020, 2021. So point being, good companies here. I understand the thesis. It makes sense to me. Now we're going to move on to the next one, which is Curate Retail. So if you're actually curious, I have a video on Curate Retail from a year ago, very long time ago now, posted actually October 27, 2021. And you can see the date there. Boom, October 27, 2021. Okay, so at the time, we can actually see what that stock was trading for. So it's QRT, Curate, QRTEA. Okay, so let's actually go back to the 1-year chart, and we can see what they were trading at in, well, that's November. I got to go even back farther, a little bit farther. So October, around here. So point is they're down 80.60%. At the time, I'll give you the gist of that video, but if you want a longer form video, it's about 40 minutes long. The gist is it looks like a cigar butt investment, probably not worth the risk. And they had some extra things happen to them on top of that. So things that we didn't even mention in the video because you cannot foresee such a thing, such as a fire happening in one of their largest facilities. A huge amount of their inventory was lost. And so you can kind of see that in their balance sheet, net of insurance proceeds. So a bit of a write down. And what you kind of get from that is maybe the company's de-risked. Maybe Michael Burry's looking at this as a deep, deep, deep value play where he's looking for that last puff, a cigar butt investment, a true textbook value play. So retail should probably think about this in the sense that it might be a bit too difficult. This one might be a hard one, right? Because you probably should understand the risks here. And I would say that there's a lot of risks to understand. I've talked with members of the community who've been saying that, well, they're interested in this only as a speculative investment, just as they're seeing the interest around this company, and it just, oh my gosh, it just is so cheap. I have stocks like that too. I have, for example, MPW. MPW is working out really well, but that's one that I was like, my gosh, it's just so cheap. And then I addressed in the video, I wasn't, bullish in the video. I told you guys basically all the risks, but it's performed well. And we said, okay, we're going to make it a speculative holding within the portfolio, but that's about it. That's where I'm going to keep it. So this might be something that, I would, if I were to forced to invest in it, I would put it in the speculative side of the portfolio. But I can get it. I kind of get it that it could see a decent pop because right now it's priced for death, right? It's priced for the worst. And is it going to go bankrupt? I don't know. Maybe they actually survive. And if they survive, I can see the value play here. And let me show you the longer term picture so you can kind of get an idea for this. So, I mean, is it going to pop up to these levels? I mean, I don't think so. But I mean, it could. I have no idea. So this is not my strong suit. I'll tell you that for this type of company. Now going on to the next one, we have Aerojet Rocketdyne. So Aerojet Rocketdyne, I actually do have a decent amount of videos on this one. And if you go on my channel and you search up AGRD, these 3 videos should come up. So they actually didn't get many views, which is quite a shame because the company has really performed really well, especially compared to the market. However, relative to the size of the channel back in those days, I think that's actually a pretty good amount of views actually, because these are one of the original videos. So they're pretty old. You see 1 year, 10 months, 9 months. Point being with Aerojet Rocketdyne, it was after this one, by the way, that we added a decent chunk more. This is after the rejection by the government in the merger between Lockheed Martin and Aerojet Rocketdyne, and I'll show you guys that in the price action. So let me show you here. And so that actually was the perfect time to buy. I'll walk you through my thought process. And the thing is, if you're buying now, you're really buying at a completely different standpoint. Right now, maybe you're speculating that the company's going to get acquired at a much higher price. Well, looking at the stock price back in the day, by the way, I originally had a smaller position in it. And under the merger arbitrage speculation that the Lockheed Martin deal would go through, in which case I would be able to realize a gain between whatever I bought it at, which I think the original shares were like at 42, something like that, low 40s at least, and $54.50. Upon the rejection of that deal, I was able to, I basically decided and concluded that it would no longer enter that speculative side of the portfolio, and I would increase it to an actual core holding within the portfolio, because what I thought when I did the research, and I cover it in some of the videos, what I was getting at the end of the day was a pretty good value, a fair value for the stock, not completely undervalued. The market wasn't giving me that kind of opportunity. Of course, if it was, the allocation would have potentially even grown to, something like, for example, when things like that happen, you see what I do with stocks. They become like a Netflix size or, like a Meta size, something like that. So with Aerojet Rocketdyne, I never got to that, but it was still a decent size within the portfolio, and I'm happy with it. So one of the things that is inside of this company is a large amount of land in Sacramento, California. We talk about that in some of those videos that I showed you there. So that has an unknown value. We have the market value and the book value recorded on the balance sheet, right? The book value doesn't do it justice because we don't know what it actually could be sold for. Well, Dr. Michael Burry might be investing in this company, kind of understanding that, well, there's hidden value here, very similar to GO and CXW, like again we discussed, because GO and CXW in that video I showed you about GO and CXW, we do get into the real estate valuation, how potentially it can be upwards of 4 times the value of the equity, which is actually quite crazy. Well, HRD, I wouldn't say it's like that extreme, but it's there. And on top of that, you were getting a business that was controlling about 70% of the solid state rocket market in the world. So it's pretty good there. And of course, you saw that Lockheed Martin wanted to buy it. And there's more context to that because Lockheed Martin's CEO came from a company called American Tower Corporation, ticker symbol AMT. So AMT is a REIT, and this guy has about 20 years of experience in the real estate market. He was looking at buying AGRD. I don't think it's not coincidental that he also noticed that there was real estate underneath and that he could probably get some value realized from that. So you could buy AGRD, sell off the real estate, and basically take it as a discount to Lockheed Martin. So Lockheed Martin shareholders could benefit or reap the rewards. And so there has also been activity of activist investors within AGRD, and I think Michael Burry is also recognizing, again, that value in the real estate. So you have all those things kind of moving together in Aerojet Rocketdyne to make a fantastic business. And honestly, I remember that some of you have actually told me that you follow me because actually I covered that stock back in the day, because no one was really covering the stock, because it's not really talked about stock. Usually on YouTube, and you got to remember this, and you might be watching this because the algorithm pushed this video to you because Michael Burry, right? And that's unfortunate because the algorithm is always kind of incentivizing content creators to, just talk about the hot topics. And so in this way, I'm kind of sneaking this in and saying like, well, look, there's a lot of value topics that we can have. But unfortunately, in order for, if you're seeing this channel for the first time, again, you're probably only seeing this because this is a hot topic, right? Michael Burry's 13F filing or whatever. But in here, I can point out this case study for you that if you didn't know about this company, well, there was plenty of opportunities to find out about this company. It's just YouTube is not, built for that. Anyways, a topic for another day, to say the least. The next stock on his list is Charter Communications and Liberty Latin America. I'm going to be covering them both together. I don't really like these companies, but I understand them. He's kind of like looking at them as, well, no one likes them, and they're basically cash cows at this point, and they're just chugging along. They're mature businesses, and they're just printing cash at this point. Charter Communications is a large American business. Liberty Latin America is kind of the same thing as Charter Communications, but in Latin America and some of the Caribbean islands. Okay, so when you put that all together, I kind of see his thesis there. All right, what I didn't tell you guys is at this point in time of the video, I'm going to be covering another 13F that you guys chose in the community, and I will oblige. So I haven't actually seen any of these holdings, and we're just going to go through them, and I'm going to share my thoughts, then we're going to close off the video. So the company or the entity is known as Greenlight, and so this one, we're going to begin by the first one, Amazon. I like the position, Amazon, very sizable position at 24%. The next one is Salesforce. Now, Salesforce, depending on where they actually acquired it at, it matters. But with Salesforce, you got a solid, really solid software business, really dominates the B2B segment in software. There's a lot of other value-added services that Salesforce has acquired over the years, such as Slack, for example, Tableau, on and on and on and on. And the Salesforce platform, a lot of businesses have been built on top of the Salesforce platform, which is actually rather fascinating. The next one is one of my favorite companies, and that's Brookfield Asset Management. I used to own Brookfield Asset Management. Shout out to everyone who followed me back in the olden days when we held Brookfield Asset Management. And I will add Brookfield Asset Management one day back to the portfolio. It will make it back. So lovely company there at 13%, solid. Next one is Alphabet, pretty biased there. Was one of my largest holdings back in the day, or just recently, and it's still a very large holding, still a core holding within the portfolio. The next one is Netflix, another core holding. I mean, come on, this guy's. I mean, it's all solid businesses. Thus far. So Netflix is another core holding within the portfolio, performed really well this year. So very happy with that one. The next one is Shopify. Wow. Talk about a pastime sweetheart back in the day. So Shopify was, Shopify and me go way back. The next one is Spotify. This is one I never got my head around. So Spotify, another interesting business. Every time I talk to artists, they say the words, I need to be on Spotify. And I like to platforms where the customer base says, I need to be on there, or the creators say, I need to be on there. So like YouTube, if you want to be a content creator, you're like, I need to be on YouTube. It's not, you don't say, I need to be on Rumble, or I need to be on this or that or this. No, I need to be on YouTube is what people say. Well, Spotify, similar story there. But I've never gotten around to understanding why as a business, they're going to make a ton of money. I feel like they're really good for the customer, the consumer, but not so much the shareholder. I haven't really gotten around to completely understanding it. And, honestly, I haven't had the time because it's in my opinion, it's a very difficult business to wrap my head around as to how in the future I'm going to generate a ton of money, or the company's going to generate a ton of money, and how I would benefit from that. So then the next one is Trepanion. So Trepanion, again, I haven't seen any of these companies. So Trepanion's one that I actually don't know. I know what Monday.com is, but I've never heard of Trepanion. So we're actually going to see that together today. So ticker symbol is TRUP, and let's see what they do. Okay, so Trepanion Inc. here. Trepanion is a pet insurance based on Seattle, Washington. Okay. Oh, I get it. Trepanion, like companion. Okay, true companion. So insurance businesses have been actually pretty good this year. However, this one, it seems, has bucked the trend because insurance companies, and there might be something different about the business model that is causing this. Because I have other videos on the channel, or, there's a position within the portfolio that's an insurance business, and most of the gains have actually been from this year. By the way, just a quick shout out. There is a video, and I covered this in the past. There are stocks that I do like, but I don't end up buying because I can't invest in everything. But I give my opinion based on subscriber requests, and I say whether or not I like, and I give just my opinion on the stock. One of them was Cigna, and Cigna actually has a video within the channel. I'll show you guys this. So Cigna is a business that I covered about 9 months ago in February 10, 2022. If you've been following the channel for a long time, the word liquidity crunch might mean a lot to you because we've been covering it for a very long time. And one of the stock sectors that I said would benefit really well was insurance companies and not so much banks. And below and behold, that actually happened with insurance companies. So at this time, the conclusion of this video was I didn't want to add Cigna because I already had insurance exposure, but I did believe that the stock was really good. And it's something that, a lot of people might say, okay, I want to do further research and consider it, adding it to the portfolio or whatnot. And the video actually only turned out about 327 views at the time because, again, very unsexy, very disgusting business. Cigna, ugh, who cares? Also, it's probably my fault with the thumbnail. Thumbnail's trash. My thumbnail game is, improving slowly but surely, trying to understand how it works. But yeah, it's performed really well. I think if we actually look at it, so again, February 10th, 2022, and then let's put in CI real quick, and then just see how that's performed over the past year. So February, close enough, 9. All right, so it is up about 32%. At the highest point, it was up 40-ish%. So, no, pretty good. As far as the market goes, it did outperform the market. I think it's actually underperformed Unum over that same time frame. So I was right in the case of actually keeping my Unum shares and not actually further exposing to Cigna Corporation. Of course, you might have said like, okay, well, why not just have more insurance? Well, it is what it is on that. So solid business there. But going over to this company, another insurance company in the pet space, it's interesting to see that they didn't really benefit. So there might be some business or reason within the business as to why that is. So really interesting. Maybe it's a good acquisition target now for the portfolio. And it's actually kind of small at $2.36 billion market cap. Yeah, that's pretty small. All right, so on to the next one. We have Monday.com, another CRM solution competing against Salesforce, but on a much smaller scale. So Monday, MNDY, software as a service. And for me, I haven't really liked these companies too much because I feel like they're very competitive. If I have some videos covering B2B and why B2B is very much of a headache. It's too much of a headache for my taste. And every time you think you're ahead, someone comes out with a cheaper, better product than yours, and then there you go, you're gonna lose some market share. So $4.6 billion market cap. It's actually performed terribly since its IPO. And again, it once it IPO'd, it kind of roared for a bit, but then subsequently has come back down. Just like a lot of these unprofitable growth stocks, this is one of those. This is an unprofitable growth stock, so you got to understand. But relative to the size of the portfolio, it doesn't seem like it's completely degenerate. Okay, so it's at a 4.6% allocation. That's perfectly fine. Like if you see what their main focus is, it's all these solid businesses. It's basically Fang and Brookfield and Salesforce. Fang, Brookfield, and Salesforce. Shopify's in there, but Shopify's already getting to a smaller size of the position. Really, this moves and dies by Amazon, Salesforce, and BAM. And Alphabet. Alphabet does it too. Then the last one we see is BUR, Burford Cap. I've never heard of this company, so again, we're going to have to look this up. And again, because I did not look at this beforehand. So Burford Capital was founded in 2009, provides specialized finance to the legal market. It operates as a finance professional service company worldwide, principals in New York. Okay, so basically what I'm getting at is the legal business in the UK, based out of the UK because it's British pounds. Okay, so let's see here. But you can buy the shares from the United States here. So let's see. Founded in 2009. Interesting time to start. Oh, I guess that makes sense. And they have office New York, London, Chicago, financing to lawyers and clients engage in litigation, arbitration, recovery. Oh, interesting little business. Never heard of it really, but until now. So I'd probably actually look into this and see. This hopefully wasn't a SPAC. I mean, it could just have IPO'd at about $9.76, but it could have SPAC'd. I don't know. This is rather suspicious. The SPAC-like structure, but anyways, something to keep in mind. Comment down below if you find out this is a SPAC. I'd love to actually. I do read all your comments, by the way. I don't always get to respond anymore because I'm so busy, but I try my best to respond. And you guys know this if you follow the channel for a long time. I do get to follow a lot. But anyways, that covers these two 13F filings, mainly Michael Burry's 13F filing, and also Greenlight Lane, not Greenlight Capital, Greenlight Lane. So. Great stuff here. So with that being said, guys, I will see you guys on the next one, and